Okay, so this is the alternative paper from 2023. The sole trader question, JP Collison. You had a choice between a sole trader or a manufacturing account. Interestingly, in the American scheme, they only give the sole trader answer, so that sort of suggests that nobody did the manufacturing account. Anyway, that's neither here nor there. So I'll do what I always do. I'll work through the workings one by one and um, throw everything in at the end. So the first thing is working one, the stock at cost was 66,200, which includes damaged stock, which cost 2-1, but now has a value of 800. So we're going to take away the 2-1 and add on the 800, or take away 1300. Because you value stock at the lower of cost or value. So if it's cost 2-1 and its value is 800, you need to value it at 800, and not the 2-1. Second one then, the suspense figure arises excuse me, as a result of the incorrect figure for mortgage interest and a payment of 1,200 for salaries only entered in the bank account. Now, I'll always work out the full mortgage interest working when I see that, because there's no point doing it later. So if we go up and look at the mortgage, you have an 8% fixed mortgage, which included 100,000 issued on the 1st of the 4th, 2022. So for the first 3 months, you had 200,000, and for the remaining 9 months, you had 300,000. So we'll just do out those sums. There's going to be a change to this later on. So you have 4,000 and 24 by 9 to us. So in total that's 22,000. Now, what we're being told is that the mortgage interest figure in the question is wrong. So we'll be told the mortgage interest paid in the question is some number. So we have to go and find that. So if we go up and look, mortgage interest for the first 3 months is 3,000 in the question, whereas it should have been 4,000. So we need to add 1,000 onto this number here, 3,000, to bring us up, which means the debit side is now 1,000 greater than the credit. So the suspense is included in rent. Now, interestingly enough, rent's on the credit side. So the debit side is 1,000 more. This is 2,422,600. This is 2,421,600. So to make the credit side equal, we're going to have to add 1,000 to the 8,000. And now both sides are up to 2,426,600. So we're always making them equal. Now, I just want to put in, I'm going to skip down a little bit here. So I want to put in that my mortgage interest due is going to be 22,000 minus 4,000, which is 18,000. Okay, it's not always the case that the 4,000 is the equal number, but in this case it is. So the 18,000 is due. All right, the second part then is that there's 12,500 for salaries entered only in the bank account. So we paid salaries of 12,500. So if we look at our salaries, they're 155,400. And we're going to have to add on another 12,500 to those. Now again, the debit side is now 12,500 more than the credit. So we're going to have to make both sides equal, and we can do that by adding on the 12,500. So I'm going to put in 12,500 here, and now both sides are equal again. So that was a straightforward suspense working. Number 3 then is our patents working, and again this is a sort of a two-parter. Patents which incorporate 6 months investment income. So we're going to work out our investment income first. Are to be written off over a 5-year period, which commencing in 2022. We're doing the books for 2022, so it's going to be divided by 5. Just note that if it's commenced beforehand, you'll divide by a smaller number depending on when it commenced. You can see that in some of the other videos. Okay, so investment income. We've got 4% investments. You got the investments 220 on the 1st to the 4th, so you have them for 9 months. So 220 multiplied by 9/12. So the investment income is 6.6. Now, 6 months is included, so 6/9 of that has been received. So investment income due, we'll start off, we're going to get 6.6 in total, and then we've only received 6/9 of 6,600. So 6/9 or 2/3 of 6,600 even should be 404. Yeah, 404. So at the moment, 2.2 is due. That might change later on. Now, that 4.4 is included in patents. So we have to add it on to patents to get rid of it. It's credit included in a debit, so to take it out, you add it on. So 57.2, add on the 4.4, brings you up to 61.6. And then that's been written off over 5 years. So patents written off will be 61.6 divided by 5. Just 12,320, which will take away from the 61.6. So that's 49,280. All right. Next job. It was discovered that finished goods had been received from a creditor on a sale or return basis. These goods had been entered in the books as a credit purchase of 19,680, and the figure includes VAT of 23,000. So what we do is we treat that as if the transaction never took place. So we bought goods, so it'll be creditors and purchases. We'll be changing creditors, purchases, and they're in our warehouse, so we're also going to change stock. So be aware of that. Now, the figure we bought them for 19,680. So creditors need to go down by 19,680. So that's the amount we owe. It doesn't matter that there's VAT included. We buy goods, we owe the creditors for them. So it'll be 53.1 minus 19,680. Now, anytime VAT is given, okay, VAT needs to be taken out. So you need to use the VAT exclusive amount for purchases. So I'm going to work out that number. So I'm going to split this up, right? So the cost price, we've got the 19,680. We're going to divide it by 123 and multiply by 100. And the cost of the stock is 16,800, which puts the VAT element, and I'll be changing this in a little bit, as 3,680. So purchases need to come down by 16,000. So we need to credit purchases by 16,000, and we need to credit VAT by 3,680. So purchases is going down. So purchases is always debit. So we start off 819,400, and if we want to bring a debit down, we're crediting it. So we're going to credit 16,000 away from that. And the reason I'm thinking in terms of credits and debits is because of VAT. So VAT at the moment is a credit of 84. And we're going to have to credit 3,680 to that. Okay, so credit 84, credit 3,680 means we're adding them on. If that was a debit, you'd be taking them away. So 84 plus 3,680 is 12,080. Now we also have to take the 16,000 away from our stock, because we don't own the stock in reality. We bought it on a sale or return basis, so unless we sell it, we're giving it back. So we take it out of our stock as if we don't have it. So assume the sale doesn't take place. Okay. Next job, the fire. So number 5. No, we're not doing that with this cost price or this VAT. Just review. They were just a sort of a working within our workings. Number 5 then. So during the year, stock which cost 18,000 was destroyed by fire. You don't have to take that out of the closing stock because it was destroyed by fire, so it's already taken out. When you went to count it, it's gone. but you do have to take it out of purchases. So purchases needs to go down by 18,000. Now the insurance company is giving us 15,900, so that's an insurance claim due because they haven't given it to us yet. 15,900. And the difference between the two of them, you're making a loss. So you had 18,000 destroyed by fire. You only got 15,900, so there's a loss on the insurance claim of 18,000 minus 15,900, so 2,100. Okay. Now, depreciation. So it says the cost of delivery vans is written off on a straight line basis over 5 years. So it's not giving us the rate. So 5 years is 20%. A full year's depreciation is discharged in the year of acquisition and none in the year of disposal. Delivery vans have 5% scrap value on the original cost. They've asked it this way a few times of late. So what does it tell us? It says during the year a van which cost 30 was traded in against a new one. Traded in for 14,000 against a new van costing 40. So we got 14,000, just be aware of that. So vans, because this is sort of the important part of this. Vans, delivery vans are cost 220. You sold the one that, or you traded in one that it cost 30 against one that cost 40. So vans are now 230. Now the depreciation of vans is of this 230 figure only, because the company policy is that you charge a full year's depreciation in the year you buy it. So you do depreciate the 40, and you don't charge any depreciation in the year you sell, so you don't depreciate the 30. So you're only depreciating this 230. So we're going to find 20% of, now there's a scrap value, so it's only 95% of 230. So you're not depreciating to zero, you're depreciating to whatever 5% of 230 is. 23, 11,500 is what they go down. That's the lowest they go down to. So we're only depreciating 95% of the value. Okay, so it'll be 0.2 by 0.95 by 230. So the depreciation is going to be 43.7 on the delivery vans. Okay, now you can also say 95% of 20% is 19%. That would be another way of doing it. So 19% of 230 would be 43.7, depending on what way you want to do it. Now the accumulated depreciation will be what we start off with. Now the scrap values are irrelevant now for a minute. So 220 minus 167 is 53,000. Add on the 43.7. When you don't have a van, you also don't have its depreciation. Sorry, I just need to, let's turn this into a percent for some reason. We just change it into a number. Sorry. So 53,000 plus 43.7. Then we have to take away the depreciation on the old van, which again will be 20% of 95% of the one we sold, which was 30,000. For the number of years we have it, remembering you depreciate in the year you bought but not you sold. So it tells us we bought this in 2018. So you have years depreciation in 2018, 2019, 2020 and 2021, but none in 2022. So we've got 4 years depreciation. So it'll be 80%. So it'll be 20% of 95% of 30,000 by 4 years, which is 22,800. So our accumulated depreciation, you have to take away the 22,800 that you don't have anymore. So that'll be equal to 53 plus 43,7 minus 22,8 is 73,9. Okay. Now, anytime you sell an asset, you have to work out its profit or loss. So the profit or loss on the sale, the value of the van is, you compare the value to the allowance. So the value is 30 minus 22,8, so 7,200. It tells you you received, or you traded it in for 14,000. So 14,000 minus 7,2 will be a 6,800 euro profit. So we got 6,800 more than what it was worth. Now it tells us the check for the net amount was included or treated as a purchase of trading stock. So the check for the net amount is the new van minus the allowance. So the new van cost 14,000, but we got given 40,000, but we got given 14 off. So we wrote a check for 26,000, so that has to come out of purchases. And that's that working finished. Alright, goods taken by Collison for his own personal use were not recorded, so we know that that's drawings. So we again just find the cost price here. So it's 6,000. Work backwards, right? So it's 6,000 divided by 125, multiplied by 100, which will be 4,800. So we're taking stock for our own use, so it's already out of stock, obviously. So, but you have to take it out of purchases and move it into drawings. So there's probably drawings in this already. So there's drawings of 40,000. So we're going to add the 4,800 on. That's 44,800. All right, into the bank working then. So the figure for bank and the trial balance has been taken from the firm's own records. So our figure for bank is, we think we're overdrawn by 33.5. So our records think we're minus 33.5. The bank's records, they think they are minus 29,340. So neither of them are correct. Somewhere in the middle is the truth. So whatever we've done, we have to adjust in the bank. Whatever the bank have done, we have to adjust in ours. So a check for 1,040 issued to a supplier been entered in the books as 1,400. So the bank have it right. Obviously, we don't. So we've put it in our books as 1,400. So the check is for 1,040. So minus 1,040 comes out of our bank, and we add back on the mistake of 1,400. Now you have to do the exact same thing in creditors, because you've made the mistake in the bank account, which means you'll have made the mistake in the double entry. So you would have reduced creditors by 1,040 instead. So minus 1,040, and then instead you put in 1,400. So undo the mistake by adding the mistake back on. So reduce creditors by the correct amount, increase creditors by the wrong amount. And that's that one done. Second one, a credit transfer of 600 had been paid direct to the firm's bank account. So the bank know about it, but we don't. So that 600 goes in our bank account. Now because we don't know about it, we've no double entry for it. So what's it for? So it's been paid to the firm's bank account on behalf of a debtor who's been recently declared bankrupt. This represents the first and final payment of 25 cents in the euro. So for every euro we got given 25 cents. So it's a quarter of the debt. So the full debt is 600 divided by 25 multiplied by 100, which is 2,400. debtors need to go down by the full debt. We're getting €600, but that represents a full debt of 2.4. Now debtors haven't changed, so I'm going to reduce debtors by 2.4. So debtors start off at, if I can find them, debtors start off at 62.3, and 2.4 is taken away. So even though we got 600, that represents a full 2,400. Now the difference between the two of those is a bad debt written off, which is a selling expense. So 2,400 minus 600 is 1,800 of a bad debt. Last part then of this one, a check for 3,000 and not being presented for payment. So we obviously know about it. It's in our books. The bank don't. So we have to take 3,000 away from that. So that'll give us 32,340. And hopefully this one is also 32,340. And if we've done them correctly, it's not 32,530. Sorry, 540 even. Have I started off with the wrong number here? 29,340. Sorry, that should have been 32. So that'll give you 32,540. Okay, so those figures balance, so they're correct. Now, provision should be made for investment income due and mortgage interest due. We've done both of those already. Provision for bad debts to be adjusted to 5% of debtors. So 5% always of the new debtors. So the new debtors is 59.9. So 5% of 59.9 is 2,995. Now, anytime you have a bad debt provision, you also have a change in BDP. So at the moment, the bad debt provision was, if there was one, was 3.9. So therefore, it's come down. So it's come down from 3.9 to 2,995. Which is a 905 decrease, and that's a good thing for us. So we're setting less money aside next year, so that's going to be another operating income. And then finally, buildings to be depreciated at a rate of 2% per annum. So that's going to be 2% of is it 800,000? Sorry, I can't fucking look on by it. 2% of 800,000, which is 16,000, and the accumulated depreciation then will also be 16,000 because there's none given. So that's them all. We can just start slotting all those numbers in. It's a good idea to know where they go. So we start at the top. We can work out any numbers that need to be worked out. So 16 minus 2,1. Should mean that's a typo. So closing stock goes into trading and current assets. Mortgage interest, the 22 goes in its own spot. Mortgage interest due is a current liability. Rent, because it's credit, is another operating income. Salaries is admin. Investment income goes in its own spot. Investment income due is a current asset. Patents is an intangible fixed asset. Patents written off will be admin. Creditors will go into current liabilities. $33,780. So purchases then 754,600 goes in the trading. The VAT is a credit, so it's current liability. Insurance claim due is a debit, current asset. The loss of the claim is admin. The delivery of vans is a tangible fixed asset. Obviously, the depreciation of vans is selling and distribution. Accumulated depreciation will go into fixed assets as a minus. The profit on the sale of van is another operating income. You don't do anything with the cost price. Drawings will go into finance buy as a minus. The bank is a minus, so it's a current liability. Debtor is a current asset. Bad debt written off is a selling expense. The BDP will go in debtors, taking them away. Decrease in BDP is another operating income. Your depreciation of buildings is admin, and your accumulated depreciation will go in your tangible fixed assets as well. That just leaves us with these. So anything we haven't seen, equipment is a fixed asset. I don't think there was a depreciation of equipment. So that accumulated depreciation is fixed assets as a minus. Opening stock goes in the trading. Sales goes in the trading. Discount is a credit, so other operating income. Salaries is changed. Patents is changed. Advertising is selling and distribution. Insurance admin. The fixed mortgage is a finance buy, long-term liability. Rent we fixed. Commission, because it's debit, is selling and distribution. If commission was credit, it would be other operating income. PRSI is current liability, and capital goes in your finance buy. So we can start at the top and work our way down. So we'll go start with our sales. So we know where all these numbers are coming through. I've got this written out. You can have your notes page beside you. 129,350 is our sales. Our opening stock from the question is 31.5. Our purchases is from our workings. So our purchases is somewhere here. Yeah, 754,600. And our closing stock is from our workings as well, which is 48,900. So it's opening stock plus purchases minus closing stock. And we take that answer away from our sales to get our gross profit. Now, our administration expenses, salaries. So we change that. That's from the workings. That's 6,000. Sorry, it's not. It's 167,900. Insurance 20,000 from our question. We've got our 2 from our workings. Then depreciation of buildings will be 16,000. We'll have our patents written off, which is 12,320, and then we have our loss and insurance claim, which is 2,1. So we add them up, put them in the middle column, we get 218,320. Selling and distribution we need to do with our vans and our commission and stuff. So we've advertising, commission, depreciation of vans, and bad debt written off. If we had if we had a discount that was a debit, it would go in there, and if we had commission debit, it would go in there, but we don't. So we've got 6,000 advertising from the question, our commission 4,800 from the question, our depreciation of vans, which we worked out in our workings, 43,700, and our bad debt written off from our bank working, 1,800. So we'll add those together and then add up all of your expenses. So add the 2 numbers in the middle together, and we'll take them away. and you're getting 281,330. To those, we need to add on our discount received. Discount received is a credit. So that is 37. That's from the question. We have to add on our rent, which was our suspense working. We have to add on our profit on sale in the van, which was 68. And we have to add on our decrease in BDP, which I think was 905. So we're going to add all of those on, and then we're going to add on to that our investment income. So we had an investment income of 66, which we'll add on, and then we had a mortgage, I think, of 22, which we'll take away, and you get 298,835. Okay, so onto your balance sheet. Again, patents from our workings are 49,280. We've got 3 fixed assets. We've buildings, 800,000. You had 1 year's depreciation of 16,000, which we'll take away. Then we have our delivery vans. They were 230. We had our accumulated depreciation of 73,900, giving you 156,100. And then we had our equipment. And equipment started off at 35. We had accumulated depreciation here of 15,000, which we didn't have to adjust, so there was no more depreciation on the equipment. So that brings it to 20,000. So we're going to add those together. You get 960,100. And then remember, your financial fixed assets, your investments, were 220,000. So we have to add on the 220 to the 960,100, and then don't forget our patents. So, all right. So then we've our debtors less BDP. So, from our workings, our debtors were 2,995. No, they're not. That's our new BDP, sorry. Our debtors are 59,9 and our BDP 2,995. So your net debtors 56,905. To that, you've also got your investment income due, which was 22. We've obviously got our closing stock, which is 48,9. And we have our, let me just check, I think we've one more. An insurance claim due, maybe. Yeah, we did an insurance claim due of 15,9. So we can add those together. So your liabilities then, well, you're definitely going to have creditors. So creditors changed. They were 33,780. We know we've bank 32,540. From the question, we've PAYE, it's 2,850, and a VAT. That changed, I think. 12,080. And then, of course, I have my mortgage interest due. It's 18,000. Okay, so we add them together. And then take those answers away from your current assets. So we just add that one on to the 1229380, and that gives you your working capital 1254035. Now your mortgage 300,000. Your capital versus the first 700,000. There's no revaluation reserve. So we have our net profit, which is 298,835. And then you have your drawings, which you have to take away. So the drawings were 44,800. So if we just add them together, and then remember to add your mortgage on, and hopefully it balances 1254035 as your capital employed. Excellent. So we've got that one right. It was actually a fairly straightforward question. There was nothing in it that you wouldn't have seen before. It was a really nice exam if you were sitting the deferred paper. So hopefully that's of some use to anyone who's working on that over the next little while.